In the past decade, cryptocurrency has grown from a niche concept into a global financial phenomenon. But how exactly do people make money from crypto? Is it just about buying low and selling high, or is there more to it than that? In this video, we'll break down everything you need to know about cryptocurrency trading, from the basics to advanced strategy. We'll dive into the key concepts, tools, and opportunities in the crypto world, giving you the knowledge you need to start earning from cryptocurrency. Whether you're a beginner or someone looking to sharpen your skills, you won't want to miss this. Understanding cryptocurrency trading. Cryptocurrency trading involves buying and selling digital assets like Bitcoin, Ethereum, and other altcoins on a cryptocurrency exchange. Unlike traditional stock markets, where assets are tangible, cryptocurrencies are decentralized and rely on blockchain technology, a secure digital ledger that records transactions. The primary goal of cryptocurrency trading is to profit from the price fluctuations of digital currency. Traders buy a cryptocurrency at a low price and aim to sell it at a higher price. This process may seem simple, but the volatility of crypto markets means that prices can change rapidly, making it an exciting but risky venture. There are different ways to trade crypto, including spot trading, margin trading, and futures contracts. Spot trading involves the immediate exchange of cryptocurrency, while margin trading allows traders to borrow funds to increase their position size, amplifying both potential gains and risk. Futures contracts allow traders to speculate on the future price of a cryptocurrency, providing more flexibility and opportunity. If you're new to crypto trading, start by understanding the basics of blockchain technology, how exchanges operate, and the different types of cryptocurrencies available. The crypto market can be overwhelming, but the more knowledge you have, the more confidently you can navigate. Types of cryptocurrency trading. There are several types of cryptocurrency trading, each with its own strategies, risks, and rewards. Here's an overview of the most common types of crypto trading. Spot trading is the most straightforward form of cryptocurrency trading. It involves the direct purchase and sale of cryptocurrencies at current market prices. When you buy a crypto asset on a spot market, you own the asset immediately, and transactions are settled on the spot. This method is ideal for beginners who want to buy and hold their assets for a longer period. Margin trading allows traders to borrow money to buy more cryptocurrency than they could with their own fund. While this can amplify profits if the market moves in your favor, it also increases the potential for loss, as you're required to repay the borrowed amount regardless of the asset's performance. Margin trading is riskier and is generally recommended for more experienced traders. Futures contracts are agreements to buy or sell a cryptocurrency at a predetermined price at a specific date in the future. This type of trading allows you to speculate on the future price of a cryptocurrency without actually owning it. Futures can be used to hedge against price fluctuation or take advantage of price movements. Like margin trading, futures trading involves higher risk and should be approached with caution. Each of these trading types has its own advantages and disadvantages, and the best method for you depends on your risk tolerance, time commitment, and trading experience. The role of cryptocurrency exchange. To trade cryptocurrency, you need to use a cryptocurrency exchange. These platforms act as intermediaries, allowing buyers and sellers to execute trades. Some of the most popular exchanges include Binance, Coinbase, Kraken, and Bitfinex. Each exchange has its own set of features, supported cryptocurrencies, and fee structures, so it's essential to do some research before choosing a platform. When selecting an exchange, consider the following factor. Each exchange charges fees for trading, withdrawals, and deposits. These fees can vary significantly depending on the platform and the type of transaction. Always check the fee structure before committing to an exchange. Some exchanges offer a wider variety of cryptocurrencies than others. If you're looking to trade a specific altcoin, make sure the platform supports. Liquidity refers to how easily an asset can be bought or sold without significantly affecting its price. Larger exchanges tend to have higher liquidity, which means you'll be able to execute trades faster and at better prices. Choose an exchange that offers an intuitive interface and provides the tools you need for efficient trading, such as charts, order books, and margin trading features. Once you've chosen an exchange, you'll need to create an account, deposit funds, and start trading. Many exchanges allow you to trade using fiat money, such as USD, EUR, or GBP, but some also accept other cryptocurrencies for deposits. How to make money through cryptocurrency trading. One of the simplest ways to make money in crypto is to buy and hold your assets for the long term. This strategy, often referred to as eco dealing, a misspelled version of hold, involves purchasing a cryptocurrency and holding it for years, hoping that its value will increase over time. Many people have become wealthy by simply holding Bitcoin or Ethereum, but this approach requires patience and belief in the long-term potential of cryptocurrency. Day trading involves buying and selling cryptocurrencies within the same day. The goal is to capitalize on short-term price fluctuations by entering and exiting trades quickly. Day traders use a combination of technical analysis, chart patterns, and market news to make informed decisions. This approach requires a solid understanding of market trends and can be risky, but it offers the potential for substantial gains if executed properly. Staking is a process where you lock up a certain amount of cryptocurrency in a wallet to support the operations of a blockchain network, such as validating transactions. In exchange for staking your crypto, you receive reward, typically in the form of additional cryptocurrency. Staking can be a passive way to earn money from your crypto holdings without having to sell or trade them. Crypto arbitrage is a strategy where traders take advantage of price differences between different cryptocurrency exchanges. For example, if Bitcoin is trading at $60,000 on one exchange and $60,500 on another, an arbitrage trader can buy Bitcoin on the cheaper exchange and sell it on the more expensive one, pocketing the difference. This strategy requires speed and attention to market inefficiency, but can be profitable if done correctly. While not strictly trading, mining is another way to earn money from cryptocurrency. Cryptocurrency mining involves using computing power to solve complex mathematical problems that secure the network and validate transactions. Miners are rewarded with newly minted cryptocurrency for their efforts. However, mining requires significant upfront investment in hardware and electricity costs, so it may not be feasible for everyone. Risk management in crypto trading. While cryptocurrency trading offers the potential for significant profit, it also carries considerable risk. The volatility of the market means that prices can swing wildly, and you could lose a substantial amount of money if you're not careful. Therefore, it's crucial to implement risk management strategies to protect your investments. Here are some key risk management techniques. Don't put all your eggs in one basket. Diversify your portfolio by investing in different cryptocurrencies, such as Bitcoin, Ethereum, and Altcoin. Diversification reduces the risk of a complete loss if one of your investments fail. A stop-loss order is a tool that automatically sells your cryptocurrency when its price falls below a certain level. This helps limit your losses and prevent emotional decision-making during market downturns. Similar to stop-loss orders, take profit orders automatically sell your cryptocurrency when it reaches a specific price target. This allows you to lock in profits before the market turns against you. Never invest more money than you can afford to lose. Always decide ahead of time how much capital you're willing to risk on each trade. A good rule of thumb is to risk no more than 1 to 2% of your total portfolio on any single trade. By using these risk management strategies, you can minimize potential losses while maximizing your chances of success in the volatile world of cryptocurrency trade. Cryptocurrency trading can be incredibly rewarding if done correctly. By understanding the fundamentals, choosing the right strategy, and managing risk, you can start earning money from crypto today. Remember, success in crypto trading requires patience, strategy, and risk management. The world of cryptocurrencies is constantly evolving, and staying informed is key to staying ahead in the game. So are you ready to dive into the world of cryptocurrency trading and start earning? If you found this guide helpful, don't forget to like, comment, and subscribe for more tips on mastering cryptocurrency trading.